And let me, start with.
I think we just need one more here. There are two on this table and on.
So let me start this, with Vikrant. As I've seen and we have seen, you have more than 100 startup, under your guidance in terms of investments which you have made. So why do you think it is really necessary for bridging of this gap? What actually is bridging the gap means, and why does it matters for these startups? Maybe I want to hear from you, and then maybe Amit, followed by, you invest at Series A level. So what do you see that, how the gap has been bridged? So maybe start with you, Vikrant.
Yeah, sure. Okay. So this started in 2017 when, TiE Hyderabad requested us to support the companies which were incubated in TiE. Many of these companies would be doing and building product of a similar nature that are getting built in Valley and Israel, but would take longer time because there was no initial capital available and initial support available, right? So they will take 5 to 7 years to build the product, which in Valley could be produced in few months and at a faster pace. That problem statement was given, to us, and with the support needed for formative years too early, right? When these companies are not cool and sexy, and not many fund houses would look at them, and they will wait for product to come out in market, would start having an MVP in place, but who would give the initial capital for those products to be disruptive in nature enough? Many government schemes and funds and grants have started now, but by the time they complete all the documentation and get the money, it takes much longer, resilience from founder to get that support. The funds are there, but funds are still dispersed after months of efforts and documentations, and something which founders are not very comfortable and used to. So when we entered into that space, we were also hesitant initially, but we realized that we made 10 investments and we got 6 exit within 2.5 years. And phenomenal multiples. So that's where we understood that in deep tech area, build versus buy decision will go in favor of buy, because the data sets get trained and there is value which people put on the table to acquire those companies. So exits were coming, and that's where we realized that, okay, this is a segment where you can enter. You just need to obviously ensure there is good filtering and there is good support system available after you have invested in them. That's what we did through our second fund, which is a SEBI registered fund. And through this fund itself, we have supported about 72 companies now. Our investment thesis is clear. We invest without investing too much time in asking, business plans and models. If the product makes sense to us, we'll support it with initial capital. And as they start to deliver what they said that they will deliver, we increase our capital later on, right? So our 1-4-16 strategy assumes that 4 times and 16 times capital would be given to you at a later stage. So fund manages its risk later on, but fund takes the risk early on, right? And that strategy had worked well for us. And that's why about 27 companies from this portfolio of 72 have gone very well in the market and have raised successive round and good multiples. Our fund is currently running at a 4x multiple overall at a portfolio level. That's a validation that, our strategy is working, and the early stage segment could still be rewarding.
Thanks. I think that's very, important points which you have mentioned. And I think the thesis which you mentioned about, investing into companies at seed level and then with a phenomenal success rate, it's really commendable. Amit, over to you in terms of, bridging the gap. So how do you see when you are investing in Series A as a fund? Because, if the company or at the seed level and then the company going to Series A. So maybe thoughts from your side.
First of all, thank you very much for inviting me. And it's very, very encouraging to see that, various different cities in India, which includes Hyderabad, is just growing with the startup ecosystem. And I'm grateful that I was been invited. Coming back to your question, it's very interesting to even understand why the gap. Just think about it. You sleep at night, you're a young child, and suddenly you get up in the morning and you see you're grown up. How do you feel, right? Is that what the importance of bridging the gap is out here? And there was an error when, specifically in 2021, when a company would raise maybe few $1 million and maybe weeks, maybe months, they would go out and raise some $50, $100 million as well. Now, what is that some of these events has led to? That you have really not gone through the step-by-step cycle of understanding your customer, truly ensuring that you have a consistency in terms of services, your processes are well made. Have you built an organization or not, right? Because when you are in early days, you start with 2 people, maybe 5, and suddenly you have got too much of money and you want to grow at like extremely fast speed. Is your team equipped? Is your technology ready? Is your processes are ready? Hence, this bridging the gap plays a very, very critical role, in my opinion. And when we look at some of these companies, I think there are 2, 3 things which is extremely important. One, it's given that the founder has to be enterprising, that's given. But ability to build the organization. Because most of the companies we have seen fail not because of money, but because they're not able to attract talent, retain talent, or ensure that they have the right people at the right place. Second is the entire process building. And the reason for importance of process building is to have better insights over your organization, including your customers. Now that is something very, very critical. And then the third is the technology, which is now becoming an integral part of everyone's system, that is it really supporting the growth? Now these are the 2, 3 things which we look at when we are looking at a company. And as some of our companies become larger and mature, the corporate governance, the readiness for surprises, the readiness for the customer insight, the readiness for if a customer shout, how vigilant you are, all these are the things which really plays an important role.
Thank you. I think you really touched upon the important aspect, and as per statistics, what we have seen that almost only 25% of the companies which have invested into seed capital reach up to Series A. And you rightly mentioned about process, technology, and I would want to now hear from, Dr. Veda and Srikanth in terms of what are the core challenges? How do you see the core challenges of this journey from seed to Series A? And what are the important criteria you would look at? That's also an important aspect which you would want to say. And please do speak about a little bit about the fund, and so that it gives a context in terms of your investment thesis, etc.
Hi everyone, Veda here. I'm a partner at India Partners. Thank you for inviting me to this conversation. To give you some background on India, we're an early stage venture capital firm, first set up in 2016, and we're investing out of our 3rd fund right now. We do seed pre-Series A and now starting to look at Series A as well. We call ourselves an operator VC. We work very closely with founders. And typically we invest about 1 to 2.5 million as the first round. We're typically the first institutional check, and we do follow-ons as the company scales. In terms of sectors of interest, we are a thematic investor. We have about 18 to 20 companies per fund. Focus areas would be enterprise tech and AI, what we called digital industries, so that would include robotics and vertical takeoff and landing type of companies. And then the third area of focus for us is healthcare and life sciences broadly, which goes across health tech, biotech, medtech. We do an occasional fintech deal as well, but otherwise these are the 3 focus areas for us. So that's the context with which I would be sharing my thoughts today. So your question was around what do you look for, right? So typically at the seed pre-Series A stage, the most important things that we look for is there a large opportunity? Is it a hair on fire type of a problem, right? So does it need to be solved urgently? That's one of the key things. And then the second thing is how strong is the founding team, right? So are the founders, do they have complementary skill sets? Do they belong to the domain and understand the nuances well and better than potentially most others in the world? And then from an attitude perspective, are they resilient? Do they have grit? Are they coachable? Because there are there is new information that comes your way all the time. And so will they work with an investor well and take feedback in a positive manner and pivot as required, right, to build a large company. So these are the key things that we look for. And then also a product which is not always completely built, at least an MVP, but with the potential to solve the large market opportunity. And if we see some interest from at least a few customers that they are interested in the product, they are engaged with it and are willing to pay for it. So that's kind of what we look for at the seed stage.
And what do you see as a core challenges when we have already invested, and how you scale it up from seed to Series A?
Yeah.
So what are the core challenges also, if you can highlight that?
Sure. So I think of, so when you compare seed to Series A, the analogy that comes to mind is, a sapling in a greenhouse which is growing to a small tree, right? And so the kind of support that it needs is different in each stage. Typically, companies struggle with a few things when they have to transition from the seed stage to the Series A stage, right? The first one being finding, beyond your initial one or two anchor customers, finding the next set of customers who absolutely love your product and are engaged with it, right? And will become evangelists for your product. So that's the number one challenge that I see companies facing. Companies also sometimes struggle to describe what their ideal customer profile is. So you have to know the market may be large. For example, there may be lots of pharma companies, right? If that's the market that you're targeting. But even within that, there will be segments and sub-segments, and there will be a specific set of pharma companies that would need your product the most. And so identifying what criteria those are to select your ideal customer, identifying that is extremely important. Otherwise, you're just burning capital trying to tackle the entire market. And then from a product roadmap perspective, I think knowing exactly what your customer wants, I think building that is very important. Sometimes because you have cool tech, you build something that the market doesn't necessarily need, those specs they don't really need. So these are things that derail companies during that stage.
Shrikant, I think I'll pass it to you. You come from a very different in terms of sector. What is, you invest into, and you've raised the fund, we're deploying now in the stage of deployment. So your perspective to hear from, the core challenges or the key areas which you look at from a fund standpoint, and how you can bridge that gap as an entrepreneur and a founder.
Sure. So, hi, I'm Shrikant, Aran 108 Capital. We like to do about 2 to 5 million. I would call it early growth, early to early growth. For us, in addition to what she already mentioned, it's important that we see some kind of customer revenue traction, that initial product market fit, and some visibility on unit economics. So these three are very important, given that we are kind of ready to invest about 2 to 5 million as our check size in the companies. So therefore, those three things are very important for us, in addition to everything that she's mentioned already, right? In terms of challenges, again, I think it's really about solving a genuine problem with a very simple solution. So when you start doing that, it's, you have paying customers. So that's what is validation for us. That's what is important for us. You may be expecting somebody is ready to pay you 50K or 100K, but if the market is only ready to pay you 10K, then that's not a product market fit in our view. So we would like to see that product market fit getting established, which the proof of it for us is maybe some initial recurring customers and maybe a slightly longer list of customers to begin with. So that's what for us is the validation and the proof of the pudding. So that's what we will look for.
Thank you. I think that's very important aspect, and coming out of the discussion is, yes, customer acceptance of your proof of concept is very important at Series A level. And maybe if I can request, I think all the panelists to share thoughts, since we would want to cover it, two things. One, what are the key areas which as a founder should look at? While he's preparing for Series A funding, and what is one actionable item which you will suggest as a fund that, that is something which you should start doing as a founder, as an entrepreneur, so that they can reach that stage. They don't come under the 75%, they be a part of that 25% of the companies who are able to raise the funds. So maybe Amit, if you can start, and then we'll go with Vikrant.
As you know that I've been investing in only in two sectors, that is education and financial service over the last 15 years. And our style has been very different. We only invest in 5 to 6 companies in every fund we launch, which is a very, very differentiated strategy. And because of that, probably our thresholds are very, very different when we look at some of these companies as well. I think if one thing which I want to advise or suggest every entrepreneur really should look at is extremely be open and flexible. And it's a very important word, right? Because while we use the word openness and flexible, is it in true sense? And it means that listen what your customer is saying. Listen what your probably employees are saying. Listen what the ecosystem is talking about. And giving you an example is that when a company is transiting from, I would use the word, maybe a 5 crore revenue to a 100 crore revenue. In a 5 crore revenue, you need probably a finance executive who will prepare your accounts. In a 20, 30 crore revenue, you'll get a finance manager. 75 crore, 100, you need a finance controller. Now, that's the transition which happens in a finance division. Now, if the founder is not open and flexible to see this transition happening and the need of building the organization. Now, this can be true in finance, this can be true in marketing, and in any other aspects of the business. That's where the challenges comes. So this is very, very critical for a founder to really look at it. And lastly, I'll go back to the 2-3 things which I mentioned, is you need to really build your org. Figure it out, who is your level second management who's going to help you out, because you cannot have all the skills. You need specific skills for specific work, and that's why the experts are there. And build MISs and processes. Don't take things for granted, because you never know what is the insight you will receive every time you look at a particular MIS. And that has to be like almost like a Bible. It's very boring to see the same thing again and again, but trust me, that's how the life is. It's very similarly to what we say, get up in the morning, we have to brush our teeth, we have to jog it. That's what entrepreneurs have to do it on a daily basis. That's how the life is.
Great. Thanks, Amit, for that insight. Vikrant, maybe quick from your side as well.
So just to pick up, what, our colleague panelist said, PMF, I will also break it into 3 quickly. For an early stage company, differentiating early PMF, scalable PMF, and scalable profitable PMF is very important. If they start to understand it timely, then they will be able to see the value. We'll try to identify those companies which can grow at 20% month on month, right? Most of the MSME company, when they grow 10 to 12% year on year, we are talking about rapid scale growth, which is 20% month on month. That translates to about 7.9x in a year. If your revenue is 10 crore today, can you become an 80 crore revenue next year? And that is the level of growth which we would be expecting companies to demonstrate, right? If they have not reached there, that would require humongous change in processes, system to deliver that kind of growth rate. Now, some people say this is an hard expectation and you're putting pressure, but that's what is expected from disruptive companies. Otherwise, it's incremental transformation company and not disruptive companies.
Okay, thank you. Yes, Shrikant.
So exact question is?
So basically, what is the one advice you will give to founders who are preparing from seed to Series A? What they should look at? What are the important elements they should be working upon in their company?
Yeah. So I think as Amit mentioned, when you're just starting off seed, angel, it's the founder, horse or the jockey, all the cliched stuff. But I think when you're coming to Series A, it's very important you have at least 1 or 2 more layers under the founding team also in place, right? We are not just betting on the founder, but could he actually sell his vision to his co-founder, to his first employee, to a couple of other employees? He's got the customers, all of that. So that team becomes all the more important. Of course, the customer traction that I mentioned earlier is also very important. Very important is that, again, we've had this discussion at the, backstage, is that a lot of us are in touch with the companies for almost, in some cases, as long as 12 months to 15 months. So we continue to monitor the traction, progress, quarter on quarter. So what is very important is really how are you scaling? Like Vikrant mentioned, for us, that's very important. You get building on the momentum that you've, you're there. And that's very motivating for us. And that's when we, start looking at you seriously.
And Dr. Veda, from your perspective, I think you come from a very different, from investments, healthcare is a very different space. So what is one advice? Because every time you cannot scale, like as Vikrant was saying, 10% month on month, I'm sure that doesn't work with you. So how do you see, and what is that advice you'll give to a healthcare entrepreneur here?
So I think deep tech, biotech is a different category altogether, right? Your milestones are very different from revenue milestones because it's at least 7, 8, 9 years before you see any kind of revenue. So that being aside, unfortunately, it is true that unless you're a company that is growing at that 20% month on month in the first couple of years, you do not graduate to Series A. That is the unfortunate reality, right? It is a difficult journey for companies. So what essentially people are looking at the Series A stage is, okay, you have a good product which people like, but do you now have a system where you can repeat your sales motion and generate same or better revenue with the original effort, right? So that's essentially what they're looking at. So my advice would be to think about from a team perspective, you have to be able to attract a good team. I think both of them mentioned about that. Keep your growth rates high, not get distracted from your product roadmap. And identify what you need to be able to build a system to reach those milestones, manage your burn accordingly so that you don't die before you reach those milestones. So that's what I would say.
Yeah.
I'd just like to add that at this stage, typically what happens is, having found that initial product market fit, the team being in place, customer traction and all of that, we would see that with that kind of 2, 4, 5 million check, there's a huge potential opportunity that you can quickly tap onto, and that's what is exciting. Therefore, the larger investments come into picture. So, you're probably in the right time, right place, and we want you to capture that market share. Rather, we believe that you can, and therefore you're ready to absorb that 2, 4, 5 million check. It's not always that if I give you a 4, 5 million check and you're very early, unlikely that you will be able to put it to good use, right? So that's also very important.
That's really, I think, very important points shared by panelists here. And really thank you for sharing these insights, because these are very important aspects which, as an entrepreneur, when you're looking at seed, you should not look at, okay, I've raised seed now, within 1 year I have to go for Series A. I think time period should not be the criteria. The criteria should be, PFM, how's your growth been, and how you're growing as a team, how you're attracting the customers, is the customers relying on your concept or not. I think those are important aspects. And thank you so much for sharing these insights. Over to you.